Okay. Hi, everyone. My name is Zichao Li. I'm from Canada. I'm running analytic. I'm working at an analytic firm um, that implements models, data models for insurances and financial clients. Today, I'm going to present the novel Bayesian pay-as-you-go drive insurance model with risk prediction and carrier mapping. Uh, due to um, due to the concern of my client, one of a major insurer in that offers in Massachusetts, they prefer me to not to disclose their names. So I'll try not to disclose their names and keep the presentation uh, more technical and more academic as I can. Okay, so the agenda is I'm going to make an introduction on pay-as-you-go insurance and discuss about the methodology. I'll discuss about the result a little bit um, since my client does not want to disclose their name, so I'll keep some of the confidential results not to be presented, and I'll do some analysis at the end of the presentation. Uh, so, well, so there's a shift in auto insurance. I don't know whether this kind of pay-as-go insurance are offered in every state in United States of America. It is actually offered uh in a lot of places in Canada as well as some of the states like Massachusetts in United States. Uh so the traditional insurance is more like you pay based on who you are, and pay as you go insurance, auto insurance is like pay based on how you drive. So give you some background information in case you are coming from a state that pay-as-you-go insurance is not offered in your state. I listed out the major insurance company in United States that offers pay-as-you-go insurance, and of course they don't name it as a pay-as-you-go insurance. It looks maybe too low class or whatever. They have different names. Some call it snapshot, drive safe and safe. They have various different kind of names, and I also give a summary of what are the key tracking factors they do. Most are tracking on miles, time of stay, braking, acceleration, speed, or plus some of other driving habits. And the problem with the traditional model, we come to the client to implement maybe the second generation model or third generation model. There is some the assumption is there is some base pricing model for those pay-as-you-go insurance already. So the problem with the traditional model is, it struggles with incomplete, imperfect data. There's low interpretability for how factors interact, and it's inflexible, hard to incorporate new data sources, and makes the risk management planning difficult for both insurance and policyholders. So we propose a Bayesian approach, which we use in a Canadian-based client before, and this is presented to the American client. It leverages the strength of Bayesian model to handle uncertainty. It mainly focusing on two tracks or two pivot of the models. One is called the naive Bayes classifier, which and the other one is the Bayesian network. So the first one, the naive Bayes classifier, is the what model, and the Bayesian network is more like the why model in academic ways. So the goal is to create a model that is accurate and understandable and can give some improvement to the insurance providers. And our contribution is that we did the implementation and we achieved the high accuracy in predicting risk tiers. Uh, basically, the client is divided their drivers into 10 ordered category or partitions, and our first model's job is to make a prediction and put them in the right risk tiers. And the second contribution is interpretability. We build a directed acyclic graph deck to visualize carrier relationships. And the third contribution is we provide challenges, insight, which challenges the necessity of geographic groupings, reinforcing pay-as-you-go insurance fairnesses. So in a layman term is we find that the actual premium they should set should not be should be more or less geographic independent instead of putting more emphasis on where the driver is physically geographically located um, based on assumption that two drivers are in the same state, which has the same insurance uh, uh, compliance requirements. And we help to optimize pricing, reduce fraud, lower costs for affordable coverages. And there are some literature reviews on pay-as-you-go insurances. In case you think this is a new term, this is actually an old term that has been researched a long time ago. It was first raised in 1968. And this kind of insurance started to appear in the market maybe 15 to 20 years ago. I'm not so sure when it's the first time it goes into market, as I was not really involved in the first generation models. And so the data source that we do is based on data from the state of Massachusetts. And the dependent variable we have is mainly on total loss, which we classify them into risk tier, and the total loss is the claim frequency times claims severity, and we also consider independent input variables like annual mileage that you drive, your rate class, which is the original insurer's risk profile, your geographic risk group, your policy period, and the um, average mile, average MPG. And in terms of data processing and challenges, there's a high class imbalance because 8 out of 9 records that we have on hand have 0 claims, so it's very hard to classify them. And the solution we provided is the strategic resampling to balance the data set for modeling. We also discreticize the total loss into 10 partitions, which is risk tiers, as I mentioned before. And the first naive Bayes classifier. So what it's like a fast, efficient sorting model. We use Bayes' theorem to calculate the probability that a driver belongs to one of the 10 risk tiers. It makes it simplifying assumption that all the input variables are independent, which isn't always the true in reality, but it's a trade-off that often works well for classification um, as well as in result analysis. And the second model we relies on is the Bayesian network. The purpose is to model complex carrier relationship between variables, and it learns a web of connections, which we use directed acyclic graph to represent. That shows how many variables directly and indirectly influencing each other. This is what it gives us why behind the risk. It allows us to ask questions like, if a driver reduces their annual miles, how does that marginally affect their premium, both directly and through the effect on other factors. And this model is built on being learned, which is part of the R package. I believe the previous presentation from Lyft was also partially built on being learned of the R package. And we made the effort to enhancing the BN package with expert knowledge. The expert knowledge is we call it ontology-driven BN, which we combine the data of it's more like an expert machine that already exists on the client side. So we use a blacklist to prevent illogical relationship being learned. Some of the example blacklist is like, you know, the rate class probably have no direct causation with the T group, and also the annual mileage have no direct relationship with the average mile per gallon. So this makes model more robust and realistic. And the result from the first model naive Bayes performances, so we improved the multi-class accuracy for 10 risk partitions. The results shows in 87.4% accuracy. And the interpretation is that the model is highly effective at categorizing drivers into correct risk tiers based on their driving attributes. And this also allows for precise and equitable premium calculations. So the actual step is that we split the data, and we take the larger data set of records as the training set. Then we use the training set to teach the naive Bayes model the patterns between driver attributes and the correct risk tier. Then we use the rest of 25% of the data to do the testing. And this testing was completely hidden from the model during the training. So it was set aside solely for the final exam, for the final test. And for the Bayesian network model, we saw a raw classification score of area under curve 0.69, which is lower than the naive Bayes model, but it also misses. Its value isn't just prediction. If you take a look at the ROC curve, by adjusting the decision threshold, we can correctly identify 80% of the high-risk drivers while falsely flagging 30% of the safe drivers. This kind of tunable performance is very valuable for insurers who want to manage risk aggressively without alienating good customers. So for each subset of the data that we analyze, we produce some kind of a carrier map to the customer, which is DAG, and the key and the DAG, the DAG reveals how variables indirectly and directly influence each other and the final premium. Due to the request of our customer, I have to remove the factors and the premium figures from this graph, and there are many DAGs were generated, and this is just a sample of them. And in terms of insight, we find that which aligns with some of the factors which aligns with everybody's impression or basic impression on insurance premium is like the annual miles is positively correlated to premium. The rate class also, I mean, the initial risk assessment as a non-pay-as-you-go driver, it's also positively correlated to the premium. And in terms of the factors, which is a little bit surprising, also continues. It's going to be the next slide. So the policy period also positively related, and the longer policy periods correlated with different driving patterns and vehicle choices, and fuel efficient cars are linked to lower premium. And what is a little bit surprising is that is the geography. If you stay in the same state, which has the same insurance compliance requirement, the geographic grouping effect on the premium is mediated through other factors like miles driven, and there's no direct or strong correlations with your geographic group and premium. So sometimes we say drivers from certain state are very wild, which is actually proven to be wrong, or at least proven to be wrong for the case of Massachusetts. And in terms of application, I'll stay short. We help to optimize the premium pricing. We also help the customer retention and provide more incentives to drivers on each policy period. And we also provide our model also helps eco-friendly insurance product, which has the premium directly related to average mile per gallon consumed. And we also provide a roadmap for future research. The deck that is dynamically generated for each selected customer group actually provides a causal framework for future studies or for future pricing for our clients. It helps to identify and control of different causal pathways, preventing bias resulting in observational data. And we also provided the insurance customer with some backdoor pathways. So the backdoor pathway is about untangling a very common type of confusion of data. The pattern looks like X, A, Y. The example is that the annual mileage, it affects the group, the tier group, which also affects the premium. So if you have a long commute, right? If you might be more likely to live in a suburban area. Your choice of driving miles influence your location choices. So annual miles, which is A, also directly influence your premium. So we know from the core model that more miles driven means a higher risk and a higher premium. So our model tells, basically provided to our customer kind of like a dynamic correlation matrices to help them to do more accurate pricing. So I'll skip the blocked pathway to keep it short. And I'll also skip the causal pathway. We have the paper published in Journal of Decision Support. If you want to know more about the blocked pathway or the causal pathway, you can read our paper. And I put my email there, and you can still ask me questions regarding that. So I'll skip this slide. And our limitation is that the data is from Massachusetts only. So what I present is more for a Massachusetts scenario. It may not apply to other states. So if you think some of the conclusions I made contradicts with what's your observation, don't be angry. This is more like Massachusetts data, and the data is dated from 2010 to 2020. We don't have the latest data due to confidentiality concerns from the customer. We also some left over is that although the large and diverse sample size help, but we see some challenges that to update the data on an annual basis, how you can update the DAG, the parameters on the DAG, which going to be a problem. We currently did not update it in a pure dynamic way. We still do it in a more like a periodic way. We think this is something that we can improve in the future. And in conclusion, we help the customer to provide high predictive accuracy, and we provide the unparalleled causal interpretability via that, and we improve the fairnesses and accuracy in pricing. And for future work, probably if we have more data, we think probably some kind of natural language processing would help if those data were not numerical or were not processed in the more systematic way. And we also think that computer visions for automated damage assessment may help faster processing of the data. As I mentioned earlier, we currently cannot dynamically adjust some of the factors purely because the frequency of damage assessment and other factors were not coming in the same frequency. So that's all my presentation. I'll keep it short. If you have any questions, you can contact me. Currently, I'm not working on the insurance client anymore, but I'm working on the Bayesian models on various concepts, like how you combine different various concept which has probabilistic dependency together. I hope I'm going to have something maybe for next year or in next 1 year or two to present to and share to everyone. Okay, that's all my presentation.